Okay, let's talk some about basis, depreciation, and asset categorization. Okay, here's our lecture overview. Now, basis rules. We've talked about basis before, and we've had this little example of Carl's capital gain on the sale of stock. So he had 7,000 proceeds. His basis was $5,000, and the basis is the amount paid for the stock if paid for with after-tax dollars. So he's already been taxed on those dollars, and so he will only be taxed on the gain. So Carl doesn't pay tax on the basis because it's already been taxed, and we've called this principle basis recovery. Taxpayers can get their basis back tax-free because they've already paid taxes on that money once. Okay, IRAs can have bases. Uh, Samuel made $20,000 total contribution to an IRA over his lifetime. Now, 12,000 were deductible, but 8,000 were non-deductible contributions. So what is his basis? Well, when he makes withdrawals, they'll be partly taxable and partly not taxable due to basis recovery because his basis is the $8,000 non-deductible contributions that he made. Okay, determining the basis. First, we're going to talk about cost basis. How much did it cost you to get it? And what's included in this is cash, the cost of property given in exchange, costs necessary to acquire the asset, sales tax, freight, and installation, and recourse debt for financing. Now, that may be the only item here that you've not heard of, or maybe you have heard of it, I don't know. But it's your initial capital used to purchase the investment. So, for example, if you buy equipment for $200,000 and you pay cash, but you also had to give up some sort of little building in exchange, then that's part of the basis, and sales tax, freight, and installation of $50,000. So this equipment will have a cost basis of $350,000. So now let's talk about recourse debt used for financing. Obviously, debt is a very, very important source of funds in order to buy equipment, uh, etc. And so let's talk about these two categories of debt, recourse debt and non-recourse debt. Now, recourse debt, the borrower is personally liable for the debt, which means the creditor can go after personal assets of the debtor if the debtor doesn't pay back the loan. So recourse debt is included in basis because that borrower is going to have to pay back that loan. At least try to. At least the bank can go after his personal assets. Okay, non-recourse debt, the borrower is not personally liable for the debt, which means the creditor cannot go after the personal assets of the debtor if the debtor doesn't pay back the loan. So the creditor can only repossess the asset that the loan was for. So non-recourse debt is not included in basis. So here's an example. Nina purchased a Rolls-Royce for $400,000 in cash, no debt. So her basis is $400,000. Now, unfortunately, she immediately totaled the car. So she has a $400,000 loss. Proceeds, nothing. Basis 400,000, loss is 400,000. You can only have a loss equal to your basis. It can't go any higher than that. Okay, example 2. She's now going to have some debt. Nina purchased a Rolls-Royce for $80,000 cash and $320,000 recourse loan from Jarvis Bank. So her basis is $400,000 because the recourse loan is included in her basis. And remember, what that means is if she doesn't pay back the debt, they can go after her personal assets in order to try to recover their money. But again, this is such a sad example. She immediately totaled the car. She still has to pay Jarvis Bank because Jarvis Bank can come after her personal assets. So she will be out the whole $400,000. She has a $400,000 loss because it was recourse debt. So proceeds, basis, loss. Now, this is such a sad example. We're totaling this car. The reason this is included in this example is that one of the major uses for basis is to figure out how much you have of a loss or a gain when you dispose of the asset, voluntarily or involuntarily. Okay, now we're going to have some non-recourse loan debt. Nina purchased a Rolls-Royce for $80,000 cash and $320,000 non-recourse loan from Jarvis Bank. So her basis is only $80,000. Now again, she immediately totaled the car. Jarvis Bank can't come after her personal assets. The bank took the risk on the loan. So proceeds upon disposal that Nina got, of course, was zero. It was totaled. Her basis was $80,000, so she's experienced an $80,000 loss here. Now, I've got proceeds here as zero. You know, in the real world, hopefully, Nina would have insurance. And so if she did have insurance, we would include proceeds, the insurance proceeds there. But anyway, we are emphasizing what her basis is here. So we are ignoring any proceeds. Okay, adjustments to basis. So basis doesn't always have to just stay the same. And of course, if you have read the book, you've heard reference several times to adjusted basis. So certain things can increase basis. What we're going to talk about is capital infusions that will increase basis. Basis can also decrease, and what we will talk about as a decrease to basis would be depreciation. So, adjustment to basis, we're going to have a capital infusion here. So, example 3. Nina purchased a Rolls-Royce for $80,000 cash and a $320,000 non-recourse loan from Jarvis. Her basis is $80,000. Suppose she doesn't total the car, but she makes payments on it. So this is a much happier example. So her basis increases as she pays off the loan, right? So you can see there, as she makes her principal payments on the loan, her basis in the car goes up. Earlier this year, Jimmy and Sherry purchased their current principal residence for $350,000. That's their cost basis. They added a room onto the home at a cost of another $50,000. Their adjusted basis in the home will be $400,000. Notice that when we're talking about capital infusion, we're not talking about repair and maintenance. So like if a window got broken and they replaced a window, that's just a replacement, that's a repair. So increases to basis due to capital infusion, you're talking big stuff here, like adding a room on. Another example, Irving Oliver built an office building designed to primarily rent space to medical professionals for $3 million. He added a wing 3 years later at a cost of $2 million, so his adjusted cost basis is $5 million. Okay, so let's talk about depreciation. First of all, we need to really understand what we're talking about when we use this word depreciation. Depreciation does not mean a decline in value. Sometimes we talk about depreciated stock, meaning that the stock has declined in value. But what we're talking about here is tax depreciation, and so it's not a decline in value. That's not what we're talking about. Depreciation is a way of expensing an asset to acknowledge that cash has or will flow out of a business. So it decreases the basis of an asset. So let's work through an example. XYZ buys equipment for $100,000 of cash. Now, of course, on the books, just an accounting refresher, XYZ, they have less cash, so we've credited cash, and they have more equipment, so we've debited equipment. So notice when they purchase this asset, there's no expense on the books. There's just an asset exchange. So no expense has been recorded. The company's profits are not lower, even though all that cash has gone out. So when XYZ depreciates the equipment, they take an expense on the books, which lowers profit and adjusts the basis downward. So they decide to depreciate the equipment $70,000 in year one. The equipment cost basis, $100,000. We're going to decrease the basis with the depreciation. And so at the end of year one, we have an adjusted basis of $30,000. Okay, the depreciation expense, now that they've taken depreciation, will be $70,000. So profits will be lower by $70,000. So there you go. So remember, depreciation is a way of expensing an asset to acknowledge or recognize that cash has or will flow out of the business for this asset. And depreciation decreases the basis of an asset. Okay, cost recovery or basis recovery. This cost recovery also is called capital recovery. By lowering profits by $70,000 in year one, the company really is lowering taxable income by $70,000, right? So they're not being taxed on $70,000 now in year one due to the purchase of this equipment. So this is capital recovery or basis recovery. So a business gets to recover the cost of assets by not paying tax on that amount of money. Now, XYZ will depreciate the remaining $30,000 in year two. These really aren't realistic numbers, but we're just making a point. XYZ expects the asset to last for 5 years, however. So, notable things about depreciation. The depreciation expense does not necessarily follow the cash flow, and the depreciation expense does not necessarily continue throughout the whole life of the asset. So, the length of depreciation time for tax purposes and the useful life of the equipment, not necessarily the same thing. They can be, but not necessarily. And tax depreciation often will differ from what's shown on the financial statement. So just be aware of that. Here's a capital recovery example. So Ellie bought an $11,000 copy machine for her business in 2011. So there's no deduction when she paid for the asset, but there is capital recovery over the life of the asset as the depreciation gives rise to expenses. So you can see here the cost basis, of course, is $11,000. In year one, they take depreciation of $2,200. And so at the end of year one, the basis has become an adjusted basis of $8,800. And so as you can see, as depreciation keeps being taken, the adjusted basis gets lower and lower. And so in this example, in year 6, we have completely depreciated this equipment. And as you can see, through the years, total depreciation is $11,000. So they've gotten to take an expense for the whole cost of the equipment over the time period of depreciation. Now, what assets can be depreciated? Assets held for productive use in a trade or business or held for the production of income. All right, held for productive use in a trade or business. So here's examples right here. This office building we're going to use again, and also this copy machine in our examples. Also, this last photograph here is a home, but it's for rent, so it's a rental property. So this home is being held for the production of income, so it can be depreciated too. Now, depreciation is allowed on productive use business assets and not financial assets like stock. So productive use means that it's actually being used to produce something. Depreciation is allowed again on productive use business assets, not personal assets. So if this is your personal home, you cannot depreciate it. Now, there's lots and lots of ins and outs to depreciation. The most common tax depreciation system is the Modified Accelerated Cost Recovery System, MACRS, and it applies to most types of property. There's a few exclusions. And so this is the only type of depreciation system for tax purposes that we're going to go over. So, MACRS. Depreciation of realty under MACRS. So we've had this term realty in the course briefly once before. It basically means land and buildings. So for example, here an apartment building, or here we have an office building. Now, real estate, realty, is depreciated using straight line depreciation. So residential real estate is depreciated over 27.5 years. And so this would be like your rental home. Commercial real estate is depreciated over 39 years. So commercial real estate would be like this office building here we're looking at. Now notice, land is not depreciable. Okay, so realty, be sure you're comfortable with this word realty. It's land and buildings. So here's our example. We know that realty is depreciated straight line. So the above office building and land was purchased for $2 million. The land was valued at $500,000. How much is annual depreciation? Now it's straight line over how many years? For commercial real estate, 39 years. Okay, so the depreciation would be $1,500,000 because we've removed the value of the land, the price of the land. We've just simply divided by 39 because it's straight year depreciation. So annual depreciation, 38,462. Okay, let's talk about depreciation of personalty under makers. And so personalty just means something that's movable. Now, it's not the same as personal use property like your home. Personalty means that it's movable and not realty. So, for example, a copy machine is personalty, and personalty is not depreciated using straight line. It's depreciated using accelerated depreciation. In other words, you take more depreciation in the early years of the life of the asset than you do in the later years. Now, the life of the asset is determined by makers' asset classes. So the life of the asset, you don't get to choose the life of the asset. And so we've got these makers' asset classes. Your true asset may last longer or shorter than this, but to make this tax system of depreciation workable, the IRS has conveniently come up with these makers' asset classes. So if you read through here, you're going to see, see what class life all of these things have. We're going to use an example of electronic office equipment. And so there it is, electronic office equipment. This is going to be a copy machine. And so as you can see, this is a 5-year class life asset. Okay, so now we know the class life, but let's look at how you actually figure the accelerated depreciation under makers. You use a handy dandy table. Okay, and we know that this asset is a 5-year asset. We know that already. So we're going to look in this column. And as you can see, this column has percentages. And if you add them down, they total 100%. Okay, so we're going to use an example of $11,000 for a copy machine. I think I need to change my picture. That's not an $11,000 copy machine. But anyway, here we go. So you can see these columns: cost basis, makers percent, depreciation, and adjusted basis. So the cost basis, we know $11,000 paid for it. These makers percents. So this year one makers percent is 20%. Where did that come from? Well, look over here at our handy dandy chart, and you can see in the 5-year column, year one is 20%, year two is 32%, etc. So that's where these percents come from. Next column is depreciation. $2,200 for year one. Where did that come from? Well, it's the cost basis times 20%. So that's $2,200. And so as we know, depreciation decreases the basis down to the adjusted basis. So at the end of year one, we have an adjusted basis of $8,800. Now let's figure depreciation for year two. Here's how you calculate it using these tables. You take the cost basis, not the adjusted cost basis, and you multiply the 11,000 times the year 2% of 32%. This gives you depreciation in year two of $3,520. So you take your 8,800 adjusted basis, you're going to subtract another 3,520. So at the end of year two, your adjusted basis is 5,280. So we go on down year after year, and as you can see, by the end of year 6, we've got an adjusted basis of 0. It's fully depreciated. We can't take any more depreciation. Now, this is 5-year property, and yet we're showing 6 years of depreciation. Another thing I want to point out to you is we said this was accelerated depreciation, that we take more in the early years. So look at the depreciation, 2200, and then it jumps to 3520, and then it starts going down. So you can see you take more depreciation in the early years, so you have less in the later years. But why is that first year less? And why do we have 6 years? Well, the mystery lies in this use of what we call the half-year convention, which applies to most property put in service. Now, the half-year convention, what that means is that in the first year, only a half a year of depreciation is taken. So that means at the end of the 5th year, you haven't taken 5 years of depreciation, you've only taken 4.5 years of depreciation. So in that 6th year, you take that last remaining half of depreciation, and that's why we have 6 years of depreciation for this 5-year property. It also explains why the year 1 depreciation is lower than year 2, even though it's accelerated depreciation. Because you do a calculation in year 1 that is accelerated depreciation, but since you only are using a half-year convention, you only take half of it. So that knocks it down to 2200. Okay, so half-year convention. There's a mid-quarter convention. If you look in your book, you'll see that we skip that in the reading. We're just not going to cover that here. We're going to cover the real basics of depreciation and not get into any weeds. Okay, for a mixed-use asset, only business use portion can be depreciated. So Maud has a home-based business. She also does extensive volunteer work in the community unrelated to the business. She buys a $1,000 copy machine. 70% of the copy machine is used for business, 30% is used for volunteer activities, and so only $700 of the cost of the copy machine is eligible for business depreciation. Now let's talk about bonus depreciation, more depreciation. Additional first-year depreciation on personalty can be taken of 100% of the cost basis. The taxpayer can elect to expense only 50% of the asset. Now notice this is for personalty only, not for realty. Here's example 10.36 in the book. I just want to go over it with you. I think it's pretty clear except for a couple of things. So Michelle buys a new business machine. It's a 7-year class property in this case for $20,000 and places it in service on July 22nd of the current year. She uses additional first-year depreciation and accelerated maker's depreciation as well. What is her total depreciation deduction for the machine for the current year? Additional first-year depreciation is available for 50% of the cost of the new tangible personalty, not for real estate, and maker's depreciation can be taken on the remaining cost of the machine. Okay, so she chooses 50% bonus depreciation. So her additional first-year depreciation is $10,000, which is simply 50% times the cost basis. The remaining $10,000 of basis can be depreciated using makers. So her maker's depreciation is $1,429, which is the $10,000 remaining basis, times 14.29%. Okay, so this is the real reason I wanted to go over this example with you. So where the heck does this 14.29% come from? It comes just from the table we were just looking at, except this is 7-year property. And so you can see in year 1, 14.29% is depreciated. In year 2, 24.49% is depreciated. And so as you go down and read through this problem, you'll see at the bottom, therefore in year 2, her maker's deduction for the machine is $24.49, which is 10,000 times 24.49%. Okay. So when you read through that, that's where those are coming from. So some income tax planning principles. Use deductions to your best advantage. Choose the options for bonus depreciation based on current and expected future income. For example, ABC bought equipment during their first year of business. They do not expect to show a profit in year 1, so they should not choose bonus depreciation for the equipment. This will leave a higher basis for deduction in future years with a higher income. Another example, DEF company bought equipment during an extremely high income year, so they probably should choose 100% bonus depreciation. DEF bought equipment during a normal income tax year. Now, they might want to choose 50% bonus depreciation so that there will be some depreciation to offset next year's income. The point here is the 100% bonus depreciation is really great because you get this huge tax deduction up front. One problem might be is that then the next year, at least for that equipment, you get no depreciation at all. And so you might go from having very low income to very high income, which sometimes is undesirable for various reasons. So you do have this latitude of using no bonus, 50% or 100%. Now let's talk about asset categories. We've got three types of asset categories: ordinary income assets, Section 1231 assets, and capital assets. So ordinary income assets, look on that first line, assets that generate ordinary income, such as business inventory. So company buys inventory, they sell it, that's their, that's what they do. They sell their inventory and they get to deduct the cost of that inventory, the cost that they paid for it. So under the last column, basis recovery, sure, they get cost basis recovery. They don't have to pay income tax on their cost of that inventory. Now, Section 1231 assets. This is depreciable or real property held for productive use in a trade or business. Okay, so that's what we were talking about with our copy machine and our office building. So, sure, we get cost basis and adjustments. The third type of asset, capital assets. So we've talked about capital assets and we're finally going to kind of define them, but it's not much of a definition. Capital assets are defined in the negative. They're just everything that's not ordinary income or not Section 1231 assets. So everything else is a capital asset. So securities like stocks, collectibles like coin collections, your personal assets, your home is a capital asset, for example, and investment assets are capital assets. So investment assets, of course, does include stocks, but it also includes things like rental home. And in the last column, do we get basis recovery for capital assets? Sure. Now, what type of asset is Nina's Rolls-Royce? Well, we don't know much about Nina. We don't really know why she bought the car. Could it be an ordinary income asset? Assets that generate ordinary income. Well, you know what? If she owns a dealership in which she sells antique cars, this Rolls-Royce could be part of her inventory. And so it could be sold as an inventory item and generate ordinary income, and she would pay income taxes at ordinary rates on that gain. So it could be an ordinary income asset. Could it be a Section 1231 asset, depreciable or real property held for productive use in a trade or business? Yeah. She might have a business in which she rents his car out like as a chauffeur service for proms or weddings or something like that. And so that could be property held for productive use in her trade or business. So it could be a Section 1231 asset. Capital assets. Could it be a capital asset? Well, sure. Maybe she bought it just for her own pleasure, and so it's a personal item. Maybe she bought it not as a dealership in used cars, antique cars, but maybe she bought it as an investment item. She's not in the business of selling antique cars, but she's going to keep it for a while, figuring it'll go up in value, and she'll sell it. So it could be a capital asset. Also, and why does this type of asset matter? Well, because of the tax treatment. So capital assets sold for a gain or loss, it gets capital gain or capital loss treatment. Ordinary assets have ordinary income, ordinary loss treatment. And we've looked at the huge difference in the tax rates of ordinary income and long-term capital gain income. So that obviously really matters. And then the third type of asset is a 1231 asset. Now, it's a hybrid because if it's sold for gain, it gets capital gain treatment. Now, part or all of the gain may require recapture, which we will discuss at a later date. And if Section 1231 assets are sold for a loss, then it gets ordinary loss treatment. So capital gain treatment if sold for a gain, but ordinary loss treatment if sold for a loss. So we'll explore that more in future episodes.